Hey, we're live. How you doing, Richard?
Well, thank you.
All right. September 28th. It's the last day before expiry in September. I can't believe September's almost over. Let's see. Got Andre from Netherlands. Hey, everybody can hear me, I assume. Kristen Cinemag, how you doing? Good to see everyone here. Dom, yep. Got the usual crew. Great to see everyone. Dennis from Munich. Right on. Let me just do some housekeeping while everybody's coming on board. Where's my slide? There they are. Okay, we're good. Excellent. Estonia, Daniel from Malaysia, Justin, UK, Stanislav. All right, got lots of folks here. Okay, so interesting. So tomorrow, Rich and I have been chatting this week off and on about tomorrow's quarterly expiry. It's a big one. There's trillions of dollars flowing back and forth. But if you've been paying attention last year, these expiries don't really seem to mean much. I seem to remember a day, it'd be like triple witching and quadruple witching, and things would really happen. But not so much. But you never know. One of these days it might surprise us. So we might get some movement.
I think the options volumes are higher than they were, but they're not probably high enough yet for the tail to wag the dog in crypto markets. I think it's getting that way, but we're not there yet.
Mm-hmm. Okay, all right. Let me go to. If we're ready to rock and roll, what I'm going to do is. So today we're going to talk about. It's quite a topic. I think you're going to love it. When to buy and sell options, a foolproof guide. That's right. That's right. Just do exactly this, and you're going to make gazillions. But in a way, it is foolproof. But it's as you'd expect. There's going to be some nuance in there. But we're going to have a lot of fun with it, and hopefully you'll learn something. We've got some good data. Well, Richard put together some good data. So let me just share my screen, and I will go over and take a look at the silly charts before we get started. And you can see this is the Bitcoin chart. Even though we had kind of a little goofy move up a couple of days ago or climbed back up, I mean, we're still in the range. There's absolutely nothing special about what's going on right now. My trend line, you look up here. If we start getting up to 27.5, then I'll start to take notice. If we did get up to 27.5, you bet your bottom dollar I'd be selling calls up here. I'd be selling calls and call spreads up here. Just like if we dip down below, getting close to 25.5, I'll probably sell some call spreads underneath there. May break.
What strikes would you aim for there, Shane?
Well, I'd be a little bit more wary on the downside. I'd probably be looking at 24,000, 23,000 strikes, maybe 23, 22. It depends how violent the move was and how high the premium went and where the IV went. But I think we've mentioned this on our Telegram group, which anyone can join, that the trade has really been to take the other side of whatever happens, because we stand in a range. We're staying in a range. Anytime it moves up, take the other side. Anytime it moves down, take the other side, because the market moves and trends. That's the pattern. And if it wants to continue doing that, that's great, wonderful. We'll make money at it. But I think that's the trade to do. So if we can get a quick push up to 27.5, I think I would love to sell 28.5, 29s, depending on the premium, and then buy 30 or 30.5 for cover, something like that. I think that'd be great. And I'd do it probably within less than 30 days. I know people from the TradFi markets poo-poo on the shorter term stuff, but this is crypto. It's a little bit different. What are your thoughts there, Richard, on strikes? So did you have any thoughts?
Well, I mean, you know me, I hardly ever even look at what the price of Bitcoin is when I trade. So,
all right.
But yeah, I don't know. I mean, I kind of feel that 29's got to be a fairly safe bet, hasn't it? To sell as call.
Yeah.
And on the downside, goodness knows. I mean, we could stop at 25. We could stop at 21. We could
Yeah, I mean, if we really want to think about this down here, we do have this, this area. Is it going to plunge through 21 overnight? Probably, unless there's a news event now. I expect all kinds of resistance down here. So
I guess there isn't very much leverage in the market, right? So I mean, pretty much everyone who's been washed out of the market's been washed out.
I think
and all the guys that are left in the market are hardcore hodlers, I think.
Speaking of hardcore, our members who 3 weeks ago voted in our poll to sell an iron condor, which we did, and this was it, 1,800 calls, 2,000 calls, which expires tomorrow, and the 1,500, 1,300 puts, well, those are going to expire tomorrow, and it was beautiful. Assuming nothing happens by expiry tomorrow morning, market gods, that was a beautiful, beautiful trade. The same thing here in ETH. We're really range bound. I mean, if we start pressing up here, I think it's going to bounce off of it, unless there's a compelling reason for it to go through, and I'll be selling call spreads up there. Same thing on the bottom. We want to come down to the bottom over here. I'll be looking to sell some put spreads down there. I have to update this chart because I don't think that one's gone now.
It was just for anyone who wasn't there for the poll. We did a poll. Was it 2 weeks ago or three weeks ago?
I think it was 3 weeks ago now, because it was about a month out. We sold the September 29th, just less than a month. Yeah.
And we asked the audience to choose what trade we would do, and they chose an iron condor, and we did that, and it's made money. But you haven't put this week's poll up.
No, I'm going to put it up right now. After looking at the silly charts, here's this week's poll. Okay. We had a lot of success. What's the preferred trade going forward?
I can't
see it. Do you want to do a direction? What's that? Oh, can you see it? Oh,
there we go.
You see it now? Okay.
Yeah.
So, directional bet up. That could, we might put on a directional butterfly. We might do a debit spread, maybe a diagonal. I don't know. We'll figure that out. Or a directional bet down. Another iron condor, if we think it's probably going to go sideways-ish. Maybe we want to do a call spread just on one side, or a put spread on the other side. Let me know your thoughts and what you think our next trade will be. At the end of the poll, I will publish that.
Is it worth me mentioning that the Reddit factoid I read today?
Sure.
Something I read on Reddit today, which must be true, therefore, is that for the past 10 years, Bitcoin has gone up 8 times out of 10 in October. So if that's going to hold, then that argues for me. Well, I guess put spread, right?
Put spread or a directional bet up. Maybe we want to put on a debit spread, or maybe we'll do a 1x3 or something like that to make it for free. But I'll think about that once the directional once the poll numbers come in.
So what is the ETH at the moment? 1624. Okay.
Yeah.
Okay. Interesting to see what it's like at the end of October.
Mm-hmm. Mm-hmm.
The options market saying it's going to be higher. The vol market.
Yeah, well,
a little bit.
It wouldn't be the first time they were wrong.
Yeah.
All right. Let me pop over and I'll start the slides. Okay.
October.
Getting funny comments in there. I didn't see them.
Yeah, Dennis said it's October. Yeah, this is the term they use.
Okay. I don't trick or treat, right? Oh, it's some tricks, not treats. All right, so let's get started. I'm going to run through. We've just got 5 or 6 slides here, nothing too crazy. I'll read through them. Rich is going to make some comments, and then what we'll do is we'll open up for some Q&A afterwards. Didn't have any new positions to talk about. I'm waiting for expiry tomorrow, so nothing I can talk about on the charts there. So much in new positions. All right, let's rock and roll. So we're talking about when to buy and sell options, and implied volatility is an annual. It's expressed annually. That means it's measured of the expected range of moves over a year, right? So if we manage an options book, and let's say once a day we're hedging to zero. So once a day we hedge to zero. We're basically able to predict whether we're going to make or lose money on any given day for any given move in the underlying asset. Clear?
As long as we can predict the realized volatility. Yeah.
All right. So if we sell options with an IV of 40% and hedge to 0 delta, we're going to make money provided the market moves less than 2.09% between those daily hedging events. Remember, we'll just do it once a day. Okay, and you can see on this line, can you see? Anyways, where it says 40% annual, I think I can turn this whiteboard on. I think we got this. Oh, there we go. Down here, right? Oh, no. For some reason, it's not allowing me to draw on here.
No, you're drawing like a 5-year-old.
I am. How come I don't see it?
You put a squidge over the 40 and 50%.
Okay, did I clear it now?
Yep.
Okay. That's supposed to be a squidge under 40% in 2.09.
Oh, yeah, okay.
It's funny that I don't see it. I don't know why it's doing that. Anyways. All right. So, point is.
And now you took it away.
I took it away now because I can't see everything with that whiteboard on.
Maybe I can do it.
Yeah, maybe. So, if we hedge more often, we're going to lock in those little losses, right? So, if we're hedging 3 times a day, we're going to be locking in those micro losses. So, we care about the total distance moved in either direction between our hedges. Okay, so example, if let's say we're hedging 10 times a day, the market has moved 0.2% each time we hedge, we're going to break even.
And it's worth mentioning at this stage that that's actually a huge approximation. In reality, if you hedge 10 times a day, then the equation changes because you're actually treating that as 3,000 microdays per year. And so the square root function changes. And so you actually are able to hedge a bit more of a daily move per day because you're chipping out the losses a bit more often. But as an approximation, this will do.
All right. Is there anything you want to talk about this annual volatility and the daily approximation?
Yeah. So look. So this is why one of the benefits of seeing the devol on and the historical vol on the Deribit website, so you can actually see what volatility is being realized versus what volatility is costing you in the market, because you can see the implied volatility of the prices in the option chain on the market. And what this is saying is that if we sell options at 40% volatility and we hedge daily, we can withstand any day on which the market moves less than 2.09%, we will make money. And any day that it moves more than that, we will lose money for that day before hedging, because we'll lock in that loss every time we hedge. So it's worth mentioning that if it moves 4%, then it's not as if we've lost 2 days worth of profits. This is an exponential function, so we end up losing like 6 days of profits or more if it moves twice as much as we expected, which is why hedging more often is more beneficial, because it sort of evens off, cuts the edges off that curve. But this gives you a way. The reason I've even mentioned this is that it starts to give you a way to visualize what volatility really means to you. And when you're seeing prices quoted in volatility, it gives you a chance to understand how much of a move in the underlying you can withstand on a daily basis. So at the moment, we're seeing implied volatility at the money on ETH of what? It's like 25% or something.
I don't have my thing open right now.
Let's have a look. Let's have a look at 13th of October, because it's a couple of weeks. 29%, so 30%. So at 30%, we can withstand a 1.5% move per day. So the way the market's been going, you think, well, if I sold that vol, I should make money, right? Because we're not moving 1.5% per day, or maybe we just under that. So on the whole, as long as I'm not paying too much in transaction fees and I hedge accurately and so on, I'll just about make money. But if the realized volatility in the market goes any higher than that, you'll be losing money on that trade, which makes that, for me, makes that sort of selling at 30% vol really kind of dicey. because I think we're realizing actually about 30. So we'll look. If I look at the historical vol, yeah, currently 28, but we've been 30 to 32 for the past couple of days, past week or so, and we were up at 36, 37 last week. And I think even in the current market, to imagine that the market's going to stay this calm, probably a bit hopeful. So my feeling is right now selling ETH options at less than 35% vol feels like a mistake, just on this basis. Now, if you've got a directional view, then that obviously changes the dynamic a little bit, because you're taking a directional view as well as a vol view, and you won't be hedging so aggressively, because if you want to be short the market, you just sell calls and now you're short the market, so you're happy. So you can then afford to sell options at a lower vol, and if you want to be long the market, of course, you'll sell puts, right? But if you're like me and you're a pure vol trader and you want to just make money from the vol, selling below 35 on ETH seems dangerous, and for me, selling below 40% vol on Bitcoin also seems dangerous. We are at historical lows. If you look at the devol index panel, you should probably share this, Shane.
The devol.
Yeah, if you go to the 9 dots and then show the.
Sorry. I'll stop the slides and I'll share my screen.
I'll tell you what. I can share mine. Here we go.
Okay.
You see me? Yeah. So look at the devol index. I mean, so the devol is currently 38. This is the 1 month sort of weighted vol of at the money 1 month options on Bitcoin, about 38%. But look at our IV rank; it's super low compared to the historical average of Bitcoin. We're well low on the graph here when we're looking at the past, whatever it is, so the past year. I mean, to sell vol today is asking for another vol spike to come in up to 55, like it did back in mid-August, or between June and July. And so if you're a pure vol seller, I mean, right now I'm a pure vol seller. I don't think it's low enough to buy personally. I'm actually just taking risk off the table at the moment, because it's just not worth the pain of selling vol at 35 and seeing it spike to 45 or 50. So I think worth keeping in mind. And even if you're doing a directional strategy and you're selling iron condors and not hedging daily, I actually hedge 24 times a day. But if you're actually for this account, the home save one, I hedge once a day sometimes. I even then I'm reluctant to do anything. I'd rather wait.
Feels very dangerous. Yeah.
But at the same time, if you're consistently trying to buy vol at these levels, you'll lose money also. So it's kind of
down if you do, down if you don't.
Where angels feel fear to trade. On the whole, if you sold vol today, you'd probably make money for the next few weeks. But there's every chance that you won't in a bad way.
And that's why we're sticking to shorter term and making sure everything's protected, so we can still earn money in this market, but not stick our necks out too much. Actually, you need to stop sharing your. Thanks. Can you guys see the? We're back on now. Okay, great. Yeah. Sometimes when you and I both do it, it kind of gets a bit goofy, but yeah, cool. Next slide. So, to Richard's point, every day that we're not hedging, right? As long as that market mean reverts to some degree, we avoid paying the costs, right, of that realized daily volatility. So if we're selling 40% vol, the market's realizing 40% vol, but it's mean reverting every time. That's great. Then for every day we don't hedge, it's like we're selling an option at 80% vol and we did hedge. Okay. This is why you're generally going to make more money selling iron condors versus naked strangles.
Yeah, and it's not. Did we do another slide on the numbers there? We've only. Yeah, we've kind of glossed over it, but the long and short of it is that if you are selling a strangle, then you buy another strangle at wider strikes, so that it costs you, say, 30% of the premium you took from selling. Then you can think of that as that's the cost of your hedging. And if you then get away without actually doing any delta hedging, and you don't get in the money, then your hedge has cost you only 30% of what it would have been had you been continuously delta hedging with futures. Now, obviously, not delta hedging to zero every day means that you are running directional risk. But in general, markets tend to be mean reverting, and because you've got your short stranglers covered, you are generally happier to let it run, even if it's running at a loss. And this is a strategy that I've used in the past when trading equity markets. You kind of almost close your winning trades early and let your losses run, because you kind of just believe in the mean reverting nature of the market. And particularly if you don't put all your bet on in one go, if you put a little bit of your bet on every day or week, you start to smear your iron condors around the market, and you get a much better chance of a positive payoff.
One last slide here. It's just talking about iron condor. So the real big advantage is that the maintenance margin is constrained. So your margin requirements are a lot less, and that long cover that you have on each side is going to cap any effect of any shock you get from spot and vol shock. So it gives us a bit more confidence to give the market time. So it starts to press you, getting closer to your strike price, your short strike price. You can kind of sit on your hands a little bit longer than you would with a strangle. With a strangle, you're better off to act a bit earlier, roll that out, adjust it, however you want to adjust that. With an iron condor, you can kind of wait a little bit longer. And every time there's a movement against a trend, we're winning that time decay while paying, again, as Richard said, if you're paying 30%, well, that's the fee you're paying versus delta hedging every day.
Yeah, it's worth saying, because the right way to trade strangles or iron condors is that when the market moves up, you buy back your puts and then wait for the market to min revert and then resell your puts, right? But when you're in a naked strangle situation, unhedged, it's too terrifying to do that, because your call leg is now at loss, and you're getting pressed on vol because the margin engine is you're getting pressed on margin. The margin engine is saying, well, if volatility went up 40% from here and the market went up by 15% from here, that call is going to be deeply in the money and horribly expensive. So send us some margin. But if you cover it, you don't get anywhere near the same impact, which means that on a move up, not only can you buy back the puts, but you can also sell some more calls. You could say, screw it, I'm going to double down and get in there and take the top off this rally. Then when you min revert, you can come back, buy back those calls, or you can resell puts, whichever way you want to do it, and pull in more premium. And for retail traders, which I assume most of you are, where you can't be continually delta hedging on an algorithmic basis, actually you will tend to make more money if you cover your trades than if you don't. I think I've said that before. But
yeah. Hey, we've got 5 minutes left. Let's answer some questions, and then I'll jump back to the poll. We'll see where the final numbers are, and we'll consider that trade, and we'll put that on. So next week we'll tell you the trade we put on. I'll put it on today or tomorrow. I might wait till tomorrow just to see what happens with expiry, but we'll see. So question from Stanislav: is it worth it to sell one day to expiry at the money or at the money plus one options, or how can we trade less conservatively if the deposit is small? Buying 1 to 2 day to expiry often just doesn't pay off. Or what style can be used for trading options if you have a lot of time? There's a lot in there.
Yeah, it's a big question, right? Is it worth to sell 1 day at the money or at the money plus one options? You've got to have brass balls to sell, particularly a naked 1 day at the money. Equally, you've got to be pretty brave to buy it, because most of the time you'll get away with it by selling it, but sometimes you'll go horribly wrong. I do a thing. If vols are higher than they are now, I often sell a 10 or 20 delta overnight. I've been playing with selling the 3 day option. It was recently introduced by Deribit. and that's a nice way of sort of just stealing a little bit of money out of the market every day, because it rolls over every day, and you after 3 days have gone past, you're just into this continuous process of selling the 20 delta call and stealing it. That kind of works until it doesn't, right? So you could never do it in big size, and you've always got to be ready to hedge it if it goes wrong. Because if you get $1,000 up move, no matter what you've done, it's going to hurt.
Yeah. Regarding those near-term expires, though, Stanislav, I love that type of trading. And yeah, if you've got all day to trade, then you want to pull out the technical indicators and be looking for opportunities to pound in on these directional trades typically, or when you feel like a move has run its course, you want to sell the other side of it. I will do that from time to time. More often than not, what I'm doing is if I see something about to break, I'll pound in, I'll buy those at the money, calls or puts, whatever they happen to be, and I'll look to make 100-300%. I'll just stagger the orders out and I'll just put them out. If it goes 50% against me, if I'm wrong, then I'm out. Or the other time that I typically do it is when we get a big move and I'm going to take the other side. I think there's going to be a bit of a bounce in there. Then I'll jump on board with those. But those don't happen too often. I have to be sitting in front of the computer too. You got to be Johnny on the spot for those.
You just been reminded of what we were discussing prior to the call. We were looking at these new leaps for September 2024.
Yes.
It's quite interesting things here, vol-wise. We're looking at 52 vol for a 1 year at the money 28k call, and 76 vol for a 100,000 call. And you could almost justify, I think, I'm not saying do this at home, but you could kind of almost justify selling eight of the 100,000 calls and buying one of the 28,000 calls. That would be slightly net positive premium, and I'm prepared to bet a fair amount of money that we're not going to be at 100,000 in a year's time, but we might be higher. So
yeah. And as we discussed, if people are believing the halving, then maybe Bitcoin will get up to 50 or 40. I mean, who knows? I mean, it could happen. But those 100,000, that's a long way off, and it almost seems like free money. I know.
Yeah, I mean, 2 years ago, 100,000 seemed imminent, but that was in the middle of QE and the massive pump, and SBF hadn't defrauded everybody, and Terra Luna hadn't happened, and all kinds of stuff hadn't happened, right? So, and we weren't about to go into a global conflict. So yeah, I kind of like. It's a long way off. It's a back burner trade, right? But I kind of quite like that trade, and I quite like this idea of buying at the money at low vol and selling out of the money at higher vol to position yourself for a move, because you can always work with the out of the money positions later on. Just a
question from Guy: how to join the Telegram group? Well, you get 7 days for free. You can go to the offer we have here. Go to Rogue Trader Academy. Any package silver and above, you get 7 days for free of the Telegram group. We put our trades in there real time, and we chat with people all day long. So check that out. What else we got here? Alex, a question for you, Richard, specifically. When managing risk in your book, in addition to being delta neutral, do you manage gamma vega risk?
So it depends on the market conditions. How do you manage gamma? It depends on the market conditions. At the moment, what the market dynamics are telling me is that I manage Vega by writing less risk. I'm actually winding down how much risk I write right now. I've pulled out some value through July, August, but it's getting harder and harder to get value out of the market. So I'm staying in the market, but in a small, because I need to get my fingers in to feel it. But I'm just exposing myself to less Vega. I do often go and buy some far out of the money, at the money, long dated straddles, or sometimes strangles, to provide a kind of a Vega hedge. Although, to be honest, short term Vega doesn't really seem to But vol doesn't really seem to affect long-term vol. I would say in general, the best way with crypto is to keep your short sales short dated, and you can always roll into the higher vol if there's a vol spike. That's actually what I found to be the most efficient.
Yeah.
Trying to get clever with buying and selling different parts of the surface.
Mm-hmm.
I think the market isn't at the moment inefficient enough to make that worthwhile doing.
And I think we've had some good luck with our diagonals lately. We feel good. We're buying those long dated options, and we're just selling those weeklies against it. It's worked out quite nice, for now for this market. So we got time for one last question, and I'll go back to the poll. Here's a quick follow up from Alex. So in current market, it's more like Vega neutral, short gamma, and harvesting theta.
It has been, and I'm doing less and less of it as I become. And I'm not alone. Every other fund manager is also doing the same thing. We're all just getting nervous that this tide is pulling out for a wave. So I'm kind of expecting a vol spike quite fairly soon.
All right.
So yeah.
Last question from Dennis regarding the volatility of 40%. So from our slides, and as a vol seller who delta hedge regularly, should I delta hedge every 1%, or should I hedge after the market moves more than 2.09%? I have to admit I can't implement thinking in a practical way. We
cover this in more detail in our course with our paying members. Sorry to sort of say that. So that the whole bunch of guidance we give. You would normally choose the percentage move at which to hedge based on the amount of gamma that you're holding, something like that. I did post the equation, didn't I? It's vol times the square root of 1/365 is the amount of movement you can withstand per day. But if you were to increase the hedging frequency, then it becomes vol times the square root of 1/365 times hedging frequency, and that means that you can actually withstand in total more of a percentage move per day because you're hedging more often. So there's a bit of consideration around that, and it's going to come down to what you think the realized vol is going to be, I guess. You want to try and tune it so you're not giving away more than half your theta in hedging costs, ideally, in my view.
All right. Hey, we are out of time. Sorry, everyone, but we'll just before we leave here, we'll go back to the poll. So, as we know, our iron condor is expiring tomorrow. It was a beautiful one. And unless we get a crazy move in the market, those are all going to expire worthless. And last week it said, should we let it expire? Should we take it off? Everybody said, let it expire. Okay, so we did. Or we are. So it looks like the consensus is to do another iron condor, but just a little bit more than a directional bet up. And I don't know if that's because of the halving coming up, or people are thinking, maybe vol's going to be increasing. But it looks like the consensus to do another iron condor. So maybe what I'll do is I'll look for an opportunity to leg in.
Why don't we do a compromise? Why don't we do an iron condor with a slight up bias?
We can do that. Do you want to sell more puts? Is that what you're saying?
Or sell the puts a bit closer?
Or just have the calls further strike away?
Yeah, I think probably that.
Okay. All right. So we'll put on something here in the next day. Like I said, maybe we'll wait till tomorrow. I'm not sure. I'm hoping vols will rise up tonight, but I don't know if they will. But either way, we'll discuss that trade next week when we come on, and hopefully it's all going very, very well. And if it's not, well, we'll talk about how to adjust it. So it'll be a good.
I like that. I like that comment from Dom. It's like picking up pennies in front of a steamroller. That was about the selling 3-day vol. Yeah,
3 days. Yeah, I saw that coming. It really is. So you want to make sure that you're just betting pennies. Let's not. If the steamroller hits you, the wallet you're going to get it's going to be a very small one. It's a idea. So, anyways, thanks again, everyone, for joining us. Always great questions, and nice to spend some time with you. So until next Thursday, happy trading, and we'll get that iron condor on for you guys.
And this video is available on our YouTube channel, and on Deribits, right?
Yeah. I don't know if Deribit has them all the time, but ours for sure has our YouTube channel. So come and visit us there. And we'll see everyone next week.
Okay. Cheers, Caps.